Hi there, everybody. My name is Jake Moline. I work for a company called StoneX. We have a new name. Please hold your applause until the end. This will be the first in a series of virtual meetings that we are conducting for CFE. My task here today, as a part of this meeting, is going to be to give you guys a somewhat brief market outlook on what we're facing in the current market today and maybe a couple different scenarios moving forward. I want to thank you all for tuning in today. We are holding these meetings virtually this year due to COVID restrictions and want to thank you all for your patience during that time. Hopefully, we're able to give you guys a little bit of insight on kind of the craziness that's going on in the market. There's a lot to process right now and kind of what we can expect going forward. I'd like to start out by kind of reviewing the previous year. 2020 was quite the year for a multitude of reasons, and the grain markets also were quite crazy during 2020, especially towards the latter part. We began the year kind of in the doldrums. Started out dealing with African swine fever and a trade war that had been looming for some time. Introduced COVID-19 into the situation in early 2020. And that obviously progressively got a little more serious throughout the year. We had a trade deal made in early 2020, mid-January, with China. Lockdowns and a downturn in demand kind of followed with the COVID-19 situation. We had a really good planting season and early weather here across the Midwest and the Corn Belt. Had massive carryouts projected by the USDA for both corn and soybeans, and things were looking pretty peachy, according to them. It started to turn drier, and then it got really dry in late summer, and we actually experienced a drought here in Iowa that definitely hurt production. In late summer, we all learned a new vocabulary word. Derecho occurred here in August, wreaking havoc on a stretch of counties kind of in central Iowa, destroying crops and storage as well. The USDA started to kind of lower production estimates around that point and revise stocks lower in the past few stocks reports. They took the opportunity to do that again in their latest stocks report in December or in January for the D1 stocks. Chinese demand started to pick up towards the end of the year. We had a dry and slow start in South America in terms of planting. And Chinese demand has really continued as we've moved into 2021. That's really what's driving the market currently. But definitely had a full 180 occur where we had massive carryouts projected early on in the year. Those carryouts are currently less than half of what they were starting out. And I realize that's an extremely frustrating chain of events for you guys to plan around when it comes to marketing. It's extremely frustrating when you're a proactive forward marketer and things change. There's nothing we can do about that. So let's try to worry about the things we can manage going forward here. Okay. I always like to start out presentations just kind of looking at some longer term price history just to give us a scale of where we're at today relative to the past. In these price charts, I like to kind of point out that the old oversupply area in corn really existed between $1.70 and $3.20 prior to the introduction of RFS and this large new demand base we call ethanol. Since 2006, that oversupply area has been confined between about $3.20 and $4.30. And you can see here we began the year really up until August in the lower end of that oversupply area. And we have gone almost straight up since then and are in the lower range, but definitely still in the demand rationing area. The point I want to make with this chart is that as we get into the demand rationing area, the potential prices that we could be looking at, it's a lot larger range. You're looking at 430 up to 825. Not saying that's going to happen by any means, but when you get tight enough with carryout and carryout to use domestically, the volatility definitely increases. Same thing can be said for soybeans. Obviously, the thing that triggered that shift into the new oversupply area was not ethanol, but just a uptick in protein demand globally, and that's really continued to this day and continues to increase. But you can see we went from the bottom of the oversupply area into kind of the middle of this demand rationing area at the moment, and a very, very large, $7 price range exists in that demand rationing area. And a lot of volatility is certain to come, I guess, going forward. One of the outside factors that's been affecting things that I think we definitely need to point out is the US dollar. It's been under pressure since early 2020, and it has contributed to the strong export demand we've seen across corn and soybeans throughout the marketing year. We've been very competitive in part because of that weak US dollar. I like to break down the different positions that exist within the corn and soybean markets. The two major players, when you look at the positions that exist across the futures market in corn, are the producer/merchandiser position and then the managed money/fund position. The funds are currently extremely long corn, estimated to hold a net long of about 358,000 contracts currently. You can see that's historically very, very large. Well, the producer merchandiser has one-upped the funds here and is estimated to hold a net short position of 764,000 contracts as of our last CFTC report, near record that was put in just recently here. So there's a lot of corn ownership being held, mostly by the commercial elevator at the moment. I don't think there's a ton of old crop corn left in producer hands at the moment, but there's a large hedge position that started to dwindle down a little bit here in recent weeks, but remains very, very large. And as you move forward, that producer merchandiser positions should start to get trimmed down some as natural demand occurs throughout the year and hedges are lifted and corn is consumed or exported. The fund position could also decrease or increase moving forward, but it's just going to be a little more nimble and easier to trim down quicker because it doesn't require export demand or the consumption of corn domestically to do that. So I would say still consider that net fund position where it's at as a liability to prices. On the soybean side, similar story. We've trimmed up the producer merchandiser position a little more quickly as exports have been and shipments have been rapidly occurring here recently. Producer merchandisers estimated to hold a net short of 272,000 contracts currently, whereas the funds are estimated to hold a net long of 124,000 contracts. Both those positions have been trimmed up relatively substantially over the last month or two, and I expect that to continue moving forward. As I said, the producer merchandiser net short has been trimmed a little quicker because those export shipments have been occurring more rapidly. I still expect that to occur over the next month here, but that'll slow down at some point when South American supply comes online. Where are we now? Okay, 2021 is surely got to be a better year than 2020, right? Well, for grain prices, it has been thus far. Hopefully the COVID situation improves during 2021 as well. We had a big old crop report in January. It's usually one of the bigger ones of the year. You get final production numbers, you get D1 stocks numbers, and then you incorporate both of those into the regular monthly WASDE balance sheets. The big surprise in the past month's report was the corn yield. Okay, when you look at carryout estimates and estimates across the board, nothing was really that surprising, even including the domestic carryout for corn. It was only slightly below expectations. It was actually just the way in which we got there that was surprising. Massive decrease in yield. They took yield down over 3 bushel per acre to 172 bushel per acre in corn. And you can see on this chart here that the change from August to January in terms of production, we cut those estimates by record values in both corn and soybeans. Over 1 billion bushels taken away in corn production from August to final. And that's really what's got the market so fired up. It wasn't the fact that carryout was where it was. It was that it was done via production and not demand. They actually ended up decreasing demand. as they decrease production. But I think you got to take those numbers with a grain of salt. There really wasn't the justification to cut export demand or feed demand really in the report, but the USDA almost felt like they had to, I think, prevent the carryout from falling further. But definitely has the risk of falling further as we move forward. You can see here the changes to the balance sheet during the January crop report. Oops, sorry. Go back to the corn balance sheet here. As I stated earlier, the corn yield was taken down from 175.8 bushels per acre down to 172 bushel per acre, down 3.8. One of the other surprises that occurred in the stocks report was that they went ahead and revised the ending stocks lower. It's been a common thing for the USDA to do that as of late, but they took the previous year's carryout down 76 million bushels to 1.91 billion. In the end, production fell 325 million bushels. Total supply was down 400 million bushels. They did trim demand by 250 million bushels, cut feed demand by 50, exports by 100, ethanol by 100. I would say the ethanol is justified, the other two not so much. But in the end, we were left with a carryout of about 1.5 billion, carryout to use of about 10.65%, and the USDA put out an average farm price of $4.20 in that report. But you can see on the right here, the scatter graph, we've got prices on the y-axis and carryout to use on the x. In the January report, when you put out a carryout to use around 10.5%, you can expect the futures price to be right around where it was, that $5 level, and that's where I would consider the fair price of nearby futures to be. Soybean balance sheet didn't see any major changes. The yield was taken down a half a bushel per acre, so we had supply drop a little bit with an increase in imports and decrease in production. They did adjust demand higher a little bit, 22 million bushels in total, most of that coming from exports and then a cut to the residual number. But in the end, carryout did fall 35 million bushels from 175 to 140, and carryout to use dipped from 3.86 down to 3.07. The average farm price improved to $11.15. But you can see here on the right that whenever you have carryout to use that low, which is extremely low at 3%, you could expect prices to be kind of where they're at, around $14 a bushel on that report day. There's definitely a wide range of potential prices, as you can see there. When we get towards the lower end of carryout to uses, you have prices from $9 all the way up to $14. We're towards the higher end of that range, and it's because we have a carryout to use ratio that's this low this early in the marketing year. All right, just a quick look at kind of how that carryout has changed since it was initially introduced in May. You can see we started the year out at 3.3 billion from the marketing year standpoint with the May estimate, and we are less than half of that now today, near 1.5 billion. Same thing in soybeans, started out the year around 400 million bushels, actually increased into July and August. And now we are down at 140 million bushels, lowest number in recent history for this early in the year. Quick look at the stocks numbers at the state level on a map level. I just want to point out, corn stocks in Iowa are down 250 million bushels from last year, and bean stocks are down over 100 million bushels. Corn basis recently has started to see a little bit of pressure, and it's more tied to a downturn in local ethanol demand fueled by some prolonged negative margins than anything. Soybean basis has kind of hung in there a little bit better, but there's really no carry in either market for processors to compete against, and they're staying fairly hand-to-mouth. I do expect things to get extremely tight in late summer on soybeans in Iowa. Quick look at the estimated net physical crush margin for an Iowa ethanol plant. You can see that we've had a negative margin environment for some time for ethanol plants, which explains why so many of them have either slowed down or shut down recently. And until more of that happens or gasoline demand starts to pick back up as the COVID situation improves, I'm fearful we're going to continue to see this rough environment for ethanol plants. One of the bright spots has been export sales, and flash sales recently have made a kind of a resurgence, I would say, into the headlines. We went for a period there where we lacked some flash sales, but they've been occurring on almost a daily basis recently, and China's been extremely aggressive in buying both corn and soybeans from the U.S. When we look at export sales and then inspections, it's important to distinguish between the two. On the top here, we have sales, and the bottom we have inspections. You can see that cumulative corn sales are almost to 2 billion, 1.9 billion, 75% of the current USDA yearly estimate. We are ahead of pace by 19%, or 478 million bushels. Whereas the shipments have just recently kind of got to exactly on pace. We've had really, really strong shipments or inspections in the past month, and we have narrowed that gap. They currently sit at 738 million bushels, right on pace. But the difference between the two, sales and inspections, is what I would label as unshipped sales, and those do have cancellation risk. Less so in corn. You can see that inspections tend to actually grow in the latter half of the marketing year and remain fairly strong. So it'll be something to watch. With where we're at currently, I would think that the USDA could end up increasing their export number throughout the marketing year here if we don't ration some more demand away. On the soybean side, well ahead of expectations and the pace needed to meet the USDA's estimate. In fact, we're already 95% of the USDA estimate. Sales on the books, 2.125 million bushels, well ahead of pace, 20% ahead of pace, almost 450 million bushels ahead of pace. The bean shipments are also well ahead of pace, 404 million bushels ahead of pace, or 18%, at 1.664 billion. The difference between the two, again, is the unshipped sales is just under 500 million bushels. And as you can see, the shipments in the latter half of the marketing year on soybeans do start to really trend lower, and haven't thus far. But I would say as you get into February, definitely the latter part of February, those are going to start to trail off, and you'll start to have maybe a few cancellations announced if it makes sense for China to do that and switch over some cargoes over to South America. Quick look at kind of where we are with the phase one trade deal, just for entertainment value here. Back on January 15, 2020, the U.S. and China agreed to a deal. China agreed to purchase $36.5 billion worth of U.S. ag goods in 2020 and $43.5 billion in 2021. They ended up purchasing $27.3 billion last year, almost $15 billion of that in Q4 alone. So they had a good late surge, but they did fall about 35% short, which I don't think anyone expected them to reach that number. We were up 65% from last year, primarily because ASF has really hindered imports of soybeans in China for the past 2 years. But the bottom line is China's going to import U.S. ag products when it makes sense for them to do that. They're going to import ag products from other countries if they're cheaper, and whether or not we have a trade deal or not probably doesn't affect that a whole lot. A couple of the kind of, I would say, back burner news stories that have kind of surfaced here as of late. Ukraine has announced they're going to officially have an export cap of 24 million metric tons on corn, with the lower yields expected there this year. Russia is going to implement some increased tariffs on wheat, try to curb domestic food prices. Both of these things are just kind of contributing to the bullish story that exists not just domestically but globally in corn and wheat. ASF has kind of re-entered into the headlines here. Just recently, it was announced that there was a new strain of African swine fever found in China. That variant, I believe, people are saying is non-lethal. It doesn't kill the pig, but instead causes a chronic condition that reduces the number of healthy piglets born. Those pigs that are found to be infected are obviously euthanized, though. I think it's a result of illicit vaccine use that has caused this kind of non-lethal strain to pop up. But you can see here, I got a bunch of charts on ASF. The main one I want you to concentrate on is the left one here, the number of sows in China. You can see they've rebuilt their herd almost back to what they were on the 5-year average, according to China. Internally, we expect that number to, or we interpret that number to be a little bit lower than that, but nonetheless, they've done a really good job building back up the herd. This is going to be something to watch. As you see in the bottom right here, the ASF cases have really trailed off since they were kind of at their peak in 2018. First one we've had in a while here. It'll be something to monitor going forward. So where are we going? South America is the primary focus of the market at the moment. Brazil and Argentina have been experiencing well below normal rainfall for the growing season they're in. It's possible to grow a decent crop at the level of rainfall they've had. And Brazil's actually had some pretty timely rainfalls, I would say. Argentina's in a little tougher spot, a little drier. But it's something to watch. You haven't yet seen massive decreases to production estimates down there. However, Argentina is starting to see theirs lowered. You can see in these vegetative health maps that on the left here, 2021, we're much drier in both Argentina and Brazil than we were last year. A quick look at the different estimates for Brazil on the left, Argentina on the right. You got the USDA estimates. A lot of these private estimates are a little bit lower on production. The StoneX numbers in Brazil are pretty much right in line with the USDA's current numbers, whereas some of these private estimates are a little bit lower in Argentina as well. So something we're going to monitor. The Argentine crop condition is starting to deteriorate. It's well below normal, so something we'll be watching moving forward. Quick look at some of the shipments, because as we start to talk about South America, the question arises, when is their supply going to come online and start to compete with the U.S.? You can see that North American corn shipments actually remain fairly strong, as we pointed out earlier in the latter half of the marketing year. But South American corn shipments do start to pick up, really starting in June, I would say into late summer. Something to monitor there. We are still going to be kind of I would say, a player in the global corn export market for some time going forward here, unless we rally prices further. On the soybean side, we're entering into the time of the marketing year where our shipments do start to trail off drastically. And as you can see here on the right, South American soybean shipments have been almost non-existent for 3 or 4 months now. But we're entering into that time frame in February and March where they start to increase rapidly. And that'll be something to monitor. If that picks up, even though they had kind of a slow planning start here this year, keep an eye out for cancellations from China and them shifting some cargoes over to South America. That does pose some downside price risk as we move forward. And as you look at the competitiveness of U.S. beans versus South American beans, we became more competitive when the tariffs were theoretically waived. The punitive tariffs were waived January 15, 2020, and we've remained more competitive up until just recently here. We're kind of on par in the spot market, and Brazil is cheaper in the deferreds than us at the moment. So that advantage to the U.S. has vanished. As we look even further into the future, this spring, the acreage battle is a hot topic right now. Beans are doing a good job trying to incentivize an uptick in acres. We expect an uptick in both corn and soybean acres versus last year, but right now, it's just from a net return standpoint, soybeans are favored. As you look at some of the history here on acreage and then my estimate on the far right here, I have 92 million acres on corn, 89 million acres on beans. The combination of the two would result in a record planted number. Between the two, there's some even higher ones out there, though. Informa, as you can see on the text box here, is calling for more than 94 million acres of corn to be planted and more than 90 million acres of soybeans to be planted in the upcoming year, which is possible. Those are high numbers, and prices are certainly telling farmers to plant as much as possible at the moment. As you look at this table here, I want you to focus on the far right side. We have what I believe to be the most likely scenario underneath Jake, and then we have a bullish and bearish scenario for the corn balance sheet as we look at the 21-22 crop year. As I said earlier, I have 92 million acres plugged in here, 178 bushel per acre yield. I've got demand at 14.6 billion, which means carryout grows back up to just below 2 billion. Carryout to use 13.5%, and the average farm price of a bushel of corn is going to be in that 370 range in that scenario. I might be a little low on the demand, but the bottom line is you can dig yourself out of the hole in corn here, I think, with what they're calling, a reasonable acreage estimate and a trend line yield. On the bullish side, if you only planted 89 million acres and we had another, production issue that caused yield to be down, say at 174, you're going to ration a little demand, but carryout probably stays in that 1.5 billion neighborhood. Carryout to use, in between 10 and 11%. And the average farm price is going to remain in the high $4 range, maybe up to $5. On the bearish side, if you planted as many as 93 million acres and had a yield as high as 180, you could grow carryout up above 2 billion and be dealing with average farm prices that are in the mid $3 range or lower. On the soybean side, I have 89 million acres, as I pointed out earlier. I've got what I consider a trend line yield at 51, a strong demand number here, almost on par with last year, and that could be a little higher. But carryout's going to be in that neighborhood of 200 million bushels in this case, and carryout to use is going to grow up to close to 5%, I would say at least. The average farm price is probably going to be just below $11. Bullish scenario, we have a planted acres number of 85 million, yield of 47 bushel per acre. Another production issue. That would mean that carryout's going to remain somewhere in that neighborhood of 140, 3.5% carryout to use, and you're going to be looking at a cash price anywhere between $13.50 and $14 probably on average. Could be higher if demand stays stronger. On a bearish side, though, if we had 91 million acres, a yield as high as 53 bushel per acre, I do have a record demand number here plugged in. Carryout could grow as high as 380, though, and carryout to use creeping up back above 8%, and we're dealing with an average farm price below $10. So the bottom line is there's a lot of different scenarios that could play out here. We're dealing with prices both in the spot and in the forward markets in new crop that are offering some really good values for you guys. When you look at kind of the seasonal of D's corn with where 2021 is in the red here versus recent history, it's a good level to get started at, and it's not something I'd be freezing up on. As I pointed out, you have potentially higher prices possible, potentially lower. And I think what the market is telling you is that it might be a wise idea to protect some downside, but leave some upside open in these markets. An interesting thing to note here is that thus far, new crop values have tracked very, very closely with 2008 values. You can see that we did continue to run things higher into the summer, but look where things ended up in the fall. It's possible that we could end up, significantly lower than we are currently in these markets. So it's worth protecting. On soybeans, same thing can be said. We're towards the very, very high end of price ranges in recent history, tracking very, very closely with 2008, and we ended up finishing lower in the fall. So one thing I would just encourage you guys to do is take a good hard look at where you are with your risk management strategies for new crop and make sure you're doing something and not freezing. If you are really dead set on running these prices higher, I have a game plan for you guys. You could get on Reddit, start to entice some of these millennial investors that are currently enthralled with GameStop, and maybe try to turn them onto corn futures. That's not a recommendation by any means, but if you guys have been following the news recently, it's been quite crazy to see what's happened there. And by the time you guys watch this video, GameStop may be down back at $10. Who knows? Anyways, as we look at the crop budgets that Iowa State puts out on the bottom here, you can see that's the total cost. You have 2021 in yellow, and that's the net return that you guys are looking at on a per acre basis. Obviously, corn on corn is the lowest here, but you have margins out there that are worth protecting, certainly. And if you end up doing nothing, it's very possible those could not be there in the fall. So it's worth managing those with some of the different tools that Austin and Mike are going to talk about in the next video here. Please reach out to them if you have questions on those. They're going to talk about the averaging contract, which is a great contract to spread out sales during a seasonally good time to market grain. And then the flex floor contract, which is basically an averaging contract with a floor. It's a cheaper way to protect your downside risk and offer you guys some upside potential. If you have questions on those contracts, reach out to them. Very knowledgeable folks there at CFE that can help you guys with your grain marketing. Leave you with one quote here. Pigs get fat and hogs get slaughtered. I didn't know that Mark Cuban coined that. I think that's been around there for a while, but just keep in mind that things always change. The only guarantee in this market is that things are going to change. So please do something to manage some of that risk. And if you guys have any questions, would like a copy of the presentation, please reach out to Austin or Mike, and they can provide you with those answers and a copy of this presentation. Thank you guys for listening, and please tune in to Mike and Austin's presentation next.
And I'm a grain originator with CFE Co-op. I cover the western locations for CFE.
I'm Mike Rosenberg, and I cover the Eastern Territory for CFE Originating Grain.
And today we are going to do part one of like a 4-part series of virtual grain meetings. And we are going to cover 2 contracts that we feel are a good fit for this market environment. And I am going to hand this over to Mike and get this PowerPoint rolling, and we will go through the first contract.
Okay, the CFE averaging grain pool, how it works. Old crop pricing period, we use July 21 futures for old crop corn and July 21 futures for old crop beans. 82 days. Pricing period is from February 12th until June 11th of this year. New crop pricing period, we use December 21 for corn, November 21 futures for beans. 126 days starting February 12th through August 13th. As you can see, the chart shows an extreme amount of volatility over the last 6 or 7 years, including last year's pandemic. We will price futures on an even amount of bushels each day. Set your bases at any time. If you enroll 5,000 bushels, you have the option to price the balance of the bushels at the market. So let's say June 1st, we think that the market has peaked price-wise. You would then price the balance of your old crop bushels, and or you would have the option to price the balance of your new crop bushels that you enrolled. Minimum of 1,000 bushels sign up on corn and beans. You deliver your bushels to your local CFE location after the pricing period is over, and you have to set your bases. Again, you can set your bases at any time during the pricing period if you feel there is that opportunity. An example, you sign up 5,000 bushels for your old crop pricing period using July 21 futures. We set your futures price for 60.97 bushels a day for 82 days. Strengths. Great tool to diversify your marketing. Firm offer to sell commodities over a specific time. Symptomatic averaging approach. Takes away the emotion. Take advantage of grain price seasonality. Easy, manageable marketing option. Multiple pricing periods. Delivery period is flexible. Sign up as February 12th of this year. Chart showing the extreme volatility. Weakness. Grain price during a specific period. Unknown final market price. Will not hit the high of the market. And there is a 2-cent fee. Please give myself or Austin Berenson a call to enroll your bushels in CFE's averaging grain pool by February 12th of this year, or any of the CFE locations can also get you signed up, but the deadline is February 12th. Now I'm going to turn it over to Austin, and he's going to present the Flex Floor Advantage contract.
So this contract, you can enroll anytime. It's not like a pool that has a deadline. Anytime you feel like the market is right, you can call us up and we'll execute this contract for you. So this is a long option strategy, meaning the farmer has to pay option cost. But with that option cost, you have 100% downside price protection. So you're essentially setting a floor, while also having upside remain possible. So if the market continues to rally, you will continue to participate in that market rally. This is a forward delivery contract, meaning the farmer selects which months he wants to deliver. So for instance, old crop, you can look at like a May contract or a July contract. For new crop, you can execute this. And therefore you would be looking at like a December 2021 contract for fall delivery, otherwise like a March for 2022, and so on and so forth. This contract prices an even number of bushels on a weekly basis, and similar to the averaging contract, if the market rallies up and you're like, I'm happy with these prices, you can sell out the remaining bushels at the market anytime. So if it's a 24-week program and you get 12 weeks done, you can sell the remaining 12 weeks at the market price. There might be a chance you get some of that option cost back when you sell out as well. This contract is a minimum of 5,000 bushels, and once you eclipse the 5,000 bushel mark, you can do increments of 1,000. So like 6,000 bushels, 7,000, 8,000, and there on out. And the farmer is in charge of setting basis on this contract, and you're setting basis for the futures month that you selected. So if you did a July contract, you're looking at June or July basis, and you have to set June or July basis prior to delivery and prior to the last day of the contract. So I like to always go through some of the pros and the cons of every contract, just to kind of help you guys understand exactly what you're getting into. And like I said before, you have 100% of your downside price protection. You're setting a floor. You still have some upside remaining. The nicest thing about this flex floor is it's 25% cheaper than an exchange traded option. So like today, for instance, if you were to buy a July 530 call, that's going to cost you 47 cents if you were to do that on like a minimum price or in a brokerage account, versus this flex floor is around 35 cents. And the reason it's cheaper is because on the back end, StoneX is buying a string of weekly puts. And so when you break it up week by week, it becomes cheaper. Like I said, you can price out of the bushels at the market anytime, whatever bushels you have left to price. This contract is very customizable. So we can customize like where you want your floor price, and that will affect how much it costs. It could cost more, it could cost less, and you can delay start it. You can move the end date up. You can pick different months. So a lot of different things we can do with this contract as far as customizing it. And again, you're in charge of setting basis. So if you think basis is going to get stronger by the time summer rolls around, you do not have to set basis today. You can wait till basis improves and vice versa. And the last pro is it systematically sells bushels each week. You'll notice I have this also in the con section, which we'll get into. But the reason I have it down as a pro is because you don't have to, you execute this contract and then you do not have to make a second decision. So it's just gonna price bushels every single week. So if you like to make one decision, you put your bushels in this contract and then let them go. You don't have to, but that's an option. So now I'll get into the downsides of this contract. The main one is, and the biggest one is the option cost. It's going to cost you, depending on the market, anywhere from 10 to 40 cents. Right now, with all the volatility that we've had, it's going to be closer to like the 33 to 40 cents. There are ways you can cheapen it up. Like goes back to customizing it. When you cheapen it up, your floor drops lower, and you can call me to discuss that in more detail. And systematically selling bushels each week, I view this, it could be a con. And the instance where it's a negative is if you execute this contract and then the market stays range bound, but then really takes off like late June, July timeframe, then you price the majority of your bushels in the range bound market, and then you only catch the rally in like in the last 4 to 5 weeks of the contract. In that instance, you would have been better off buying a July 5:30 call. Okay, so here we'll get into some of the nitty gritty and the details of it. So this example is based on the July 2021 futures. When this contract was typed up, July 2021 was at 524, and that is going to be our floor price. The cost is going to be 34 cents. And so your actual net floor is 490. The 524 minus 34 cents. The next few slides, I'm going to be talking all Chicago Board of Trade. So you'll have to account for basis at a later time. Okay, so we have 5,000 bushels divided by 24 weeks from this date until this date. That gets you roughly 208 bushels a week. And you are getting, so you're pricing those bushels each week. If the market's higher, you get the higher price. If the market's lower, you get the floor price. So you get the better of the two. If the market shoots up to $6 this week, you price your 208 bushels at $6. If the market shoots to say 475 this week, you price your 208 bushels at the floor of 524. The way I like to view it is during those 24 weeks, you're going to price at a different level every single week. And what this does is it takes a weighted average of all of those weeks combined together. That gets you a price, say it's 550. And then once you get your weighted average price, you take your 34 cents off. So what happens if the market goes down? Pretty straightforward. You sell all 5,000 bushels at the floor price, which is 524. Take off the cost of the option, 34 cents. You have a net price of 490 plus or minus basis. Compared that, in this instance, the market looks like it's trading at like 350, 375. So 490 is still better than that. In the next example, the market rallies up, every single week you price at the market price on Friday, the closing price on Friday. So like this week right here, you priced, looks at like 5.90. Up here, you priced pretty close to $7. It takes your weighted average price from the weekly settlement. And in this example, it was $6.50. Still have to take your option cost off. You have a net futures price of $6.16. So if the market stays flat, you're pricing some weeks above the floor, and then you're pricing some weeks at the floor. Again, weighted average price. In this example, it was $5.34. Take the option cost off of 34 cents, and that gets you a net futures price of $5. So that concludes the flex floor. We appreciate you watching this, and we appreciate your business. If you have any questions over this, if you have any questions from Jake's presentation, definitely feel free to reach out to us. We'll be more than happy to help. And we are actually looking for questions to cover in the next 2 to 3 meetings that we have. Thank you.